Most people think investing is something you do when you're older, when you've got a steady paycheck, a house, maybe even kids. But here's the thing. What if you could start earlier? What if you could take the tiniest amount of money, even just a few bucks, and begin a journey that could change your entire financial future? That's what I want to walk you through today. Zero to Investor, a micro-investing journey. And trust me, it's not just theory. This is based on real investing wisdom, mixed with modern tools that anyone, anywhere can use right now. My first investment story. Let me rewind for a second. I actually bought my first stock when I was 11 years old. Yep, 11. Most kids that age are saving up for a new bike or video games. But me? I was fascinated by these little symbols scrolling across the newspaper. Tickers for companies like AT&T and US Steel. Now, let me be real with you. I didn't know what I was doing. I was just chasing patterns, trying to read charts, and pretending I could predict the market. It was fun, but let's be honest, profitless fun. I made no money, just a lot of mistakes. And that's the thing. A lot of new investors start that way. They look at stock prices like lottery numbers, not realizing what those numbers actually represent. Finding a framework. When I was 19, something changed. I stumbled on a book that completely reshaped the way I thought about money, The Intelligent Investor by Benjamin Graham. Now, this wasn't just another get-rich-quick guide. Graham laid out 3 simple but powerful rules. Rules that the greatest investor of all time, Warren Buffett, still swears by. And honestly, these rules apply just as much to someone micro-investing $5 a week on an app today as they did to someone building a billion-dollar portfolio 70 years ago. Let me break them down.
Rule number 1. A stock is part of a business. Sounds obvious, right? But when you're just starting out, it's easy to forget. When I was 11, I could rattle off stock symbols like a baseball card collector. X was US Steel. T was AT&T. I knew them all. But here's the catch. I didn't know anything about those businesses. Think about it this way. Would you buy half a restaurant without knowing what food it serves, who the chef is, or whether customers even like eating there? Probably not. But that's exactly what people do when they buy stocks without understanding the companies behind them. This is the foundation of value investing. Before you click buy, ask yourself, what business am I really getting into? Who are its competitors? How strong is its management? Does it have long-term staying power? That's how you shift from speculating to investing.
Rule number 2. Mr. Market is crazy, and that's good for you. Here's where it gets interesting. Graham introduced this character called Mr. Market. Imagine you have a business partner who shows up at your door every single day. Some days he's cheerful, offering to buy your share of the business at sky-high prices. Other days he's depressed, practically begging you to take it off his hands for pennies. That's the stock market. The lesson? You don't have to listen to Mr. Market every day. You don't have to sell just because prices fall. You don't have to buy just because prices rise. Your job is to wait patiently and take advantage when Mr. Market gets too drunk, too depressed, or too manic. That's when the best opportunities appear. Think about it. In 2020, during the pandemic crash, you could buy shares in great companies, Apple, Microsoft, Amazon, at massive discounts. People panicked. Smart investors saw it as Black Friday for stocks. Rule number 3. Always demand a margin of safety. Now, let's say you're driving a truck across a bridge. The sign says weight limit 10,000 pounds. If your truck weighs 9,800 pounds, do you risk it? Probably not. You look for another bridge. That's the margin of safety. In investing, it means you don't buy something unless it's selling well below what it's actually worth. Why? Because the future is uncertain. Even the best analysis can be wrong. That cushion, the safety margin, protects you from mistakes and surprises. This principle is timeless. Whether you're putting $20 into a fractional share or $20 million into a company, you never want to dance on the edge. Fast forward, how this applies today. Okay, let's bring this back to 2025. You might be thinking, that's all great, but I don't have thousands of dollars to invest. I can't buy into Apple or Tesla or Coca-Cola. Here's the good news. You don't need to. Today, thanks to micro-investing apps like Robinhood, Acorns, or Stash, you can start with as little as $5. That's less than the cost of a Starbucks run. You can literally go zero to investor in minutes. And here's where it gets powerful: compound growth. If you invest just $5 a day, yeah, the price of a latte, and earn a modest 8% annual return, in 30 years, you'd have over $200,000. And if you bump that up to $10 a day, you'd be looking at nearly $500,000. That's the magic of starting small but staying consistent. The Moat: finding businesses that last. Here's another big lesson from Buffett. In capitalism, if you've got a castle, competitors are going to attack it. If you open a hot new restaurant, someone's going to copy your menu, hire away your chef, and undercut your prices. That's why you want businesses with a moat, a durable competitive advantage that keeps rivals out. Think Coca-Cola. There are plenty of sodas out there, but Coke owns a place in people's minds. It's not just sugar water, it's happiness in a bottle, tied to movies, sports, and celebrations. Competitors can spend billions, but they'll never replace that emotional connection. That's a moat. And as a micro-investor, you want to look for companies with moats: brands, patents, networks, or customer loyalty that can't be easily replicated.
Filtering the noise. Here's another trick I learned. Most of the time, the smartest move is knowing what not to do. If someone bet me I had to pick 10 Dow Jones stocks that would beat the market, I wouldn't start by picking winners. I'd start by eliminating losers, the industries I know are too tough, too unpredictable, or too competitive. Car dealerships, too many moving parts. Airlines, historically brutal. Restaurants, high failure rate. The stock market is full of shiny objects, but your success depends more on what you ignore than what you chase.
From micro-investing to real wealth. So, where does that leave us? Here's the roadmap from zero to investor. Start small, start now. Even $5 counts. Think like a business owner. Every stock is a piece of a company. Ignore the daily drama. Mr. Market is crazy. Don't let him control you. Always demand a margin of safety. Don't overpay. Look for moats. Durable, competitive advantages matter. Filter out the noise. Not every stock deserves your attention. Be patient. Great investments take years, not days. The punch card test. Buffett once said, "Imagine if you had a punch card with only 20 holes. Every time you make an investment, you punch one. And once you've punched all 20, that's it. No more investments for life." Think about how careful you'd be, how much research you'd do, how seriously you'd take each decision. That's how you should approach investing. Even if you're only putting $20 into a stock, act like it's one of your 20 punches. Because here's the truth: you don't need hundreds of investments. You don't need to chase every trend. You just need a few good decisions made with discipline that compound over time. Final thought. So whether you're 11 years old buying your first stock or 30 years old just downloading your first investing app, the journey from zero to investor starts the same way, with a decision. Don't wait until you feel ready. Don't wait until you have enough. Start where you are with what you've got, because the earlier you start, the bigger your compounding snowball becomes. Zero to investor, a micro-investing journey, isn't about getting rich overnight. It's about planting seeds today that grow into financial freedom tomorrow. And trust me, that's a journey worth taking.